Hello, good morning, everyone. Good morning, good morning, good morning, good morning, good morning. Good morning. So, in regulatory governance, we will now discuss corporate governance and corporate social responsibility, both important for the pre and the mains. And in the mains, you will use these very, very heavily. Not required, Charan, don't worry. Not required. For the means, you would use this very, very heavily for paper 4 as well, because this is common to paper 4. And also at the same time, a lot of case studies are based on corporate governance. ठीक है, तो शुरू करते हैं. So first things first, we will first study corporate governance. Now, when we generally try to understand what is corporate governance or what are the general aspects to this, we will first understand one, what is the meaning, two, very, very important for paper 4 as well, who are actually the stakeholders of corporate governance, three, generally what is the evolution in the way we have developed, you know, uh, our mechanisms or frameworks for corporate governance. There could be a timeline of events, committees, laws, judgments, which effectively constitute the evolution of corporate governance. Fourth, once we've understood this, we will then understand exactly what the legal framework is, what governs corporate governance, what are the general issues. In addition to this, what are some best practices globally? And while we're doing best practices globally, we would also look at some case studies of failed corporate governance in the world. Okay? And then we would generally understand way forward. Okay? Now, the idea is a fairly simple one, which is that the word corporate governance is slightly, one can say, slightly contradictory. If you think about it, corporate for the larger part of it means the private sector. I know there are government owned corporations also, but corporate for the larger aspect means the private sector. But despite it meaning for the private sector, there are some institutional boundaries that have been set for them as corporations. They have to apply to a certain type of organizations, like a private limited or a public limited or a limit liability partnership, whatever it may be. So, corporate is a legal entity which mostly operates in the private sector. But given the fact that the scale at which it operates makes it a very important stakeholder in governance. So there is some degree of regulation for the corporate sector. right? That's where it all comes from. So when I look at the meaning of the word corporate sector, corporate governance, it is nothing but a system through which corporations are directed, the way they are managed, operationally, otherwise, the way they are controlled, and therefore, eventually, how are they accountable? It is very important to understand why would you do this? You would do this inherently for the larger concepts of fairness, transparency, and accountability, right? So, if good governance is how government is run in the most effective manner, efficient manner, accountable manner, the same way corporate governance is how the corporates are run in the most effective manner. Now, good governance has certain frameworks, certain principles, sevaktam, etc., etc. We've discussed them before. So these would also be based on certain principles. So therefore, the principles that they would be based on have been very clearly identified by the OECD. As it is exam में हमको ये लिखना है. I have given you these principles in your notes as well. A good diagram should work very clearly on this. Okay. So the principles of corporate governance as identified in OECD is A, you're able to govern them effectively, very, very importantly. This simply means that the way you're running them is effective. Then you have a fair treatment of shareholders. Third is you have to ensure that there is a degree of honesty and integrity with which your investments are made and run. Then it has to be centered around involving every stakeholder in the process. And we will discuss who these stakeholders are. It should all be based on the principles of disclosure and, you would say, transparency. And it should very clearly identify the responsibilities of the board are. Okay. Now, let's understand this. Are we okay with this? We're fine with this so far? Yes or no? Okay, good. Now, why does it all matter so much? What is so unique about it? Why are we getting into this? When we're looking at a corporate, it is a business. One of the first things it would require is capital, right? This capital could be an initial capital, right? Or it could be subsequent capital. This subsequent capital can be in the form of debt. This could be in the form of share equity, right? Or it could be anything else, correct? The initial capital, debt, share equity, anything would come from somewhere, either banks or financial institutions or promoters or investors. And investors could be, institutional investors, or you and I, retail investors, right? Or it could be anything else. Now, in all of this, do you think there could be an aspect of public money involved? Now, public money does not mean government money. Money of the public at large, could it be involved? Yes. Okay. The second aspect would be that money is coming in large quantities to do a certain job. So there has to be a management. Now, you would expect this management to be independent, to always keep the company above everybody else. They should be unbiased, they should be independent, and they should always keep the firm's interest above all. Yes. So you would require the management to have some kind of a separation between the investors, right? Because if this is effectively a separation of powers problem, this would effectively be a separation of powers problem. Yes or no? Good. So you would want a degree of independent directors, because if the people who own the money and are the same people who are managing it, they would play with money, right? Then, to ensure all of this is done well, you would require at least a third party supervision, right? Which is often called audit. And they would effectively be working in society with social and environmental obligations, right? Now, do you understand the need of corporate governance? There is a large chunk of money involved, either directly invested by by the public of our country, or given through banks, which is again holding the money of the public. How corporates are run would effectively be about allocation of capital, and they function in a society. They would have environmental obligations. They should be able to comply with the laws of the land. And whether they're doing, if the CAG can audit the government sector, then we should also have an audit of the private sector. Right? If you spend X on Y, where is X? So this explains to you the need of corporate governance. Because sometimes what you do becomes bigger than you. It's a very interesting concept. The I me mentality washes out. For example, when you will get into services, you will be a part of something much bigger than you. You will have your individual aspirations and your ambitions, and you know how you want your life to be. But at the end of the day, you are a part of a system much bigger than yourself. You are a part of a process much bigger than yourself. And it will be a very humbling experience. You would realize that while everybody else is just working for themselves, you would be one of the very few people in the country who would not just be doing so. Whether it is the civil services or the armed forces or the medical services, right? That is the concept. That is the idea. So if you are dealing with something which is far bigger than yourself, then you will have to have a certain degree of checks and balances. So the most basic question that we must have when we study corporate governance is, why the hell should we govern them? Why do we need to tell them what they do? Because what they do impacts us. Tomorrow, if they cook their books and take a fraudulent loan and default on the loan, does the system not collapse? Then ultimately you're taking a loan from the bank. Now, does this mean do we not need corporates? Yes. Government is not a driver of growth. A common mistake that we in India have is government is the driver of growth. Government is not the driver of growth. Government is a facilitator of growth. It can give you systems and infrastructure and opportunities, but at the end of the day, the driver of growth in an economy will always be the private sector. And if the driver of growth in an economy will always be the private sector, that means the private sector must be given that sense of accountability. You need the private sector because they are the ones who will drive revenue, who will drive taxation, who will drive innovation, who will drive industry, who will drive employment. Employment is a common social function jointly shared by the state and the private sector, right? Government jobs is not the answer. Government jobs is not the answer. The government cannot create unlimited jobs. How many jobs can the government create? The answer lies in creating jobs in the private sector. Yes or no? That so employment is something which is the government's problem. It is also the private sector's problem. In fact, the private sector tends to be a solution. So when there is so much at stake, labor welfare, employment, environment, society, management of funds, capital, there needs to be processes, structures, ideas as to how you would largely run it. Clear? So, this therefore effectively tells you who and what your stakeholders are. In the notes, I've given you a very simple diagram of it: shareholder, board of directors, management, employees, suppliers, customers, creditors, society, environment. Yes, those stakeholders are extremely important in answering case studies in paper 4. Yes or no? Simple, very easy way to do this. Yes, board of directors, which is senior management, then generally how the management is to be done, your employees, suppliers, and customers, government, creditors, environment. You can break suppliers and customers into two different ones also, and you will see a lot of overlap. The board of directors can also have some shares, the management can also have some shares, the employees can also have some shares. In some cases, the government might also be holding some shares in your company. Clear? To understand this more conceptually, what you could generally do is look at it in terms of degree. So, there are primary stakeholders and there are secondary stakeholders. Primary stakeholders could be of two types: primary social and primary non social. Similarly, secondary social and secondary non social. And you can rearrange them and give better structure. So, social here means you're directly dealing with them on a frequent basis. So, the primary social investors are going to be your primary social stakeholders are going to be investors, employees, anybody who's lent you some money, your customers. You have a direct relationship to the company. Investors, employees, lenders, and customers. You have a direct relationship. Non-social would be that, okay, local communities, global citizens, the nature, environment. There's a direct relationship, but not a very human interaction. It's direct, but it's not human. You're not directly dealing with the environment. Your actions are consequences on the environment. Then you have secondary social and secondary non-social. So secondary social would be, say, government. society, unions, media for that matter. So here the influence is going to be indirect. If you look at secondary non-social like trade bodies, regulators, competitors, religious groups, very rare influence, but influence. Are we okay with this? Do we understand this? Yes or no? Very good. Simple enough. Now, clear? Why are they important? Because shareholders are actually owners who are investing capital with the expectation of return. Board of directors is the ultimate oversight body in the corporate. They are to represent shareholder interests. Their job is to ensure ethical conduct. The management is responsible for day-to-day operations. The employees, their welfare and their rights are very, very critical for sustainability. When I look at suppliers and customers, they are affected by corporate decisions. Government and regulators, they set laws and standards for ethical conduct. Creditors who have invested, who've been interested in a stable, predictable company performance. Society at large is because your impacts on the environment are huge. Clear? Understood? Good. Now, what has generally the evolution been? I've given you a broad timeline, but I'll walk you through some basic aspects. Most of what we've done in corporate governance in India has been reactive. Something has gone wrong. So, in reaction to that, we've tried to make things better. And we've generally seen some massive corporate disasters in the country or in the world generally. I'll give you specifics and then I'll tell you very similar for environment also. And I'll give you a larger phase wise analysis. So it all effectively starts in the year 1990s. Across the world also, it generally starts in the year 1990s, where you will see most of the work happening. So in 1992, there's a parliamentary committee in the UK called the Cadbury Committee. They recommend global corporate governance codes for the first time. Now we have a non-state actor in India, a very, very important representative of business interests called Confederation of Indian Industry. You may have heard of something else also called FICCI, Federation of Indian Chambers of Commerce and Industry. Similarly to that. So between 1996 to 1998, the Confederation of Indian Industry proposes what is called a voluntary code. Now, that voluntary code is if you want to implement it, great. If you don't want to, then it's okay. Then in 1999, the government appoints the Kumar Mangalam, yes, the Kumar Mangalam Committee, or the Birla Committee, if you want to call it that. Easy to remember, the Birla Committee. On the recommendations of the Birla Committee, on very clear cut recommendations, clause 49 of the listing agreement is introduced by SEBI. Okay. This clause 49 would eventually get replaced by a better set of regulations, but originally what is called clause 49. Now, please understand what is clause 49. It'll take 2 minutes. Can I explain what is clause 49? Yes. Okay. So it is a corporate governance clause which was inserted back in the day when you are listing your company in the stock exchange. Clause 49 laid down certain specific disclosures. So clause 49 was introduced by SEBI to the listing agreement, which means when you're going to list your company, there is a list of things that you have to disclose. Clause 49 was that specific addition. Okay. So what did clause 49 ask you to do? It asked you to have a proper dedicated board of directors. It requested you to have a separate set of independent directors, and in larger corporations, the chairperson of the company, the MD of the company, and the CEO of the company cannot be the same person. You should have mandatory audits, and the frequency in which you are conducting your basic routine, you know, reviews and internal setups was to be implemented. It also provided for mechanisms for whistleblowing and all of those things. So clause 49 is effectively that. Are we okay with this? Yes or no? Good. Then in 2002 to 2003, the Naresh Chandra and Murthy committee, अपने नारायण मूर्ति, 100-day work week, they spoke of better and strengthened independent directors. Very clear identifications and certifications for CEOs and CFOs. ठीक है. अब ये इंडिपेंडेंट डायरेक्टर्स क्या है, हो क्या रहा है? Do we understand the difference between board of directors and the management? Board of directors is like the cabinet committee. Management is like the bureaucracy which is going to implement everything in detail. Key decisions are taken here. So that's why if you have a seat at the board, are you a director in the company? Do you have a seat at the board? ठीक है. So one of them here, or a few of them here, depending on the size, would be independent directors. Okay. Yeah. Some of them, yes, some of the board of the directors will also come from senior management. The CEO will always generally have a seat in the board. Generally. Then 2004, they tend to revise clause 49 little bit better, make it, stronger, more contemporary. Then 2009, India's most remarkable Satyam scam happened. This leads to a series of reforms. One of them is that you redesign the entire Companies Act, which is an remember Prevention of Corruption Act 1947. Then they redesigned it in 1988, and they made significant amendments in 2018. Something very similar in 2013. We have a brand new Companies Act. It has everything. It has independent directors provisions. It has CSR provisions. It has related party transactions, that giving money to somebody known to you, like a kickback. The principles of rotating your auditors, everything is given here. Okay. Then in 2015, clause 49 gets replaced by a proper defined set of documents called LODR. This is by SEBI. Listing obligations and disclosure requirements. Okay. And 2021, SEBI also comes up with BRSR, which is Business Responsibility and Sustainability Report. This is mandatory for the top 10 of top 1000 companies listed on SEBI. Do we understand this? Yes or no? Does this seem familiar? Yeah, last year. Now tell me something honestly. I know it's not just about one question, but if you were only studying for the pre, would you have studied this for the pre? No. No compilation, nothing, no newspaper, nothing. It's the theory part, which is why at least once study everything together. Then before the pre hyper focus on the pre, before the mains hyper focus on the mains. It is not easy to study everything together. Study in depth, study it as a subject, and then you customize it to the need of the exam. Do we understand this? It is very important. The questions are not tough. They've asked you in the prelims, there is no minimum requirement of CSR funding. Okay? If you know your CSR provisions, you'll be able to answer it. If you know your basics, that if BRSR is for the top 1000 listed companies, then SEBI is the one responsible. It cannot be the RBI. RBI is a banking regulator. RBI does not regulate companies. Clear? Good. So, this is how we generally evolved our frameworks. Satyam scandal was misreporting, cross transfer of assets, underreporting of financial books, eventually led to key personnel being sent to jail, which is very, very rare. Okay, are we clear now? Does it make sense? No, so in the middle, like for example, between 2015 and 2017, we've had a Kotak committee also, which has given you reforms, suggested reforms on the composition of the number of directors. There should at least be one woman director, and all of those things. Yes, there has been a lot of work that is going on, no doubt. Today, CSR is also looked at very, very seriously. Then there's also ESG, your environmental and social governance aspect of it. Right? Those things are there, of course. So if you look at it, Companies Act is here. What about it? लिखा है इधर. So this also then tells you what your legal framework is. It is sort of managed, it is sort of run in a very different manner. There is the Companies Act of 2013, whose job is to give you the basic fundamentals. These fundamentals have to be very, very clear. Board composition, audit committees, CSR, disclosure norms, everything comes from the Companies Act. Then you have certain regulators which give you certain guidelines. So you have the SEBI LODR, listing and disclosure requirements. The name itself, listing is listing in the stock market. Then where are you getting listed? At a stock market. So that specific stock market is also going to have some listing agreements with you. If you're coming to Bombay Stock Exchange, then we will tell you we need more of these things. CB will give you a general template, and then you will have specific stock exchanges, right? Good. And then you would have certain accounting and secretarial standards. So, Institute of Chartered Accountants of India, Institute of Company Secretaries of India, they will generally give you certain compliances. You need to get your books audited is mandatory under the Companies Act, has to be done by a certified auditor or a chartered accountant. Do we understand this? Yes or no? Good. So then the question is, how are we doing this? What are we doing for better corporate governance? A basic question is, what is being done for better corporate governance? Are we okay with this? Yes or no? Good. So, one, your board of directors composition should include gender diversity. Second, you must have some independent directors without any bias or conflict of interest, right? Managerially, the MD and the CEO roles have to be different. Yes. So BOD is clear. Go back to the stakeholders. BOD is clear. ठीक है. Then stronger auditing guidelines, external auditors, plus on rotation. Third, adoption of CSR guidelines. Fourth, reporting of related party transactions, RPT, which is if I am a company and I'm spending money which may indirectly benefit an employee externally, is a related party transaction. Do we understand this? Yes or no? सिंपल भाषा में रिलेटेड पार्टी ट्रांजैक्शन का मतलब होता है कि भाई आप किकबैक ढूंढ रहे हो. सिंपल भाषा में मतलब यही होता है. ओरिजिनली ये भी क्लॉज 49 नहीं था. ठीक है. तो इसको ऐसे समझो. नहीं, insider trading is if I am telling you the secret of a company to another person who can gain from using that secret. Related party transaction is when you are transferring any resources, any services between a company and a related party, whether a price was charged or not. समझ रहे हो? Irrespective of whether a price was charged or not, हम एक अकाउंट से दूसरे अकाउंट में कोई रिसोर्सेज ट्रांसफर पैसा ट्रांसफर कर ले. Clear on this? Typically, generally, you will see sale or purchase of goods, buying or selling of property, leasing of property, uh, availing or rendering certain services. A lot of times, appointment to an office of profit also. इस तरह से. Are we clear on this? Yes. Good. Like a sister company. So you can't spend more than 10% of your annual consolidated turnover on RPTs, and all of them have to be very clearly disclosed. That's the basic idea. ठीक है. Understood? समझ आ रहा है? Very good. Excellent. Good. So this is the general structure. Double taxation avoidance is not for one company. It is between two. It is also done through the government. Companies cannot negotiate DTAs between themselves. That is why. Good. No, DTA cannot be written. No. Just 1 second. Yeah. I was just resetting the timer. ठीक है. Board composition means executive directors and non-executive directors. Executive directors come from core management, CEO, CFO types. Independent directors are generally people who have nothing to do with the company. Companies need to have proper audit committees, and two-thirds of these audit committees are members or independent directors. Proper mandated CSR committee, post committee, everything. Okay, good. Now, what are the core issues? Where are we going wrong in all of this? See, the problems are fairly simple. A law is as good as how it is to be implemented. The first problem is the ownership problem. Remember, I told you initial investment given by somebody that's called a promoter. Most companies in India are promoter driven. They're not driven on credit. They're not largely driven on, shareholders. They're largely promoter driven. They're either family run और दे आर स्टेट ओन्ड. अब वो फैमिली रन है या तो स्टेट ओन्ड है, तो रिलेटेड पार्टी ट्रांजैक्शंस के चांसेस बढ़ जाते हैं. उसका प्रॉपर्टी इधर लगा दिए, इसका उधर लगा दिए, उसको ये दे दिया, क्या कर लो, किसको रोक लोगे. सेकेंड इज देर इज अ जेन्युइन इंडिपेंडेंस प्रॉब्लम. आप जिसको इंडिपेंडेंट डायरेक्टर अपॉइंट कर रहे हो, देयर इज अ प्रॉपर एग्जाम दैट यू हैव टू क्वालिफाई नाउअडेज फॉर यू टू बी सिलेक्टेड फ्रॉम. But it's a very easy exam. You just have to understand corporate, I think, basics of company law. It's not that you can write an exam today. You have to have some work experience before you become an independent director. नहीं तो 20-20 साल के बच्चे इंडिपेंडेंट डायरेक्टर बन गए तो दिक्कत हो जाएगा ना, बड़ी बड़ी कंपनीज. So the problem is that when you're choosing independent directors, there could be some back end, familiarity. Three, implementation is a problem. We built a corporate law service, there is a registrar of companies, but a lot of what happens still happens in thin air. There's absolutely nothing. Then there is a liability for directors. क्योंकि अगर बहुत ही कॉम्पिटेंट लोगों को आप ले आओगे, और अगर कंपनी में कुछ गड़बड़ होता है तो सबसे पहले डायरेक्टर जाता है. The director of the company is legally responsible for what happens in the company, right? So there is a lot of risk involved. अब खुद ही सोचो, आप अगर डिफेंस सेक्रेटरी, आप जेल जाओगे नहीं, लेकिन आप किसी कंपनी के बहुत सीनियर, आप किसी कंपनी में डायरेक्टर हो, आप जेल जाओगे. हाँ, क्लियर. सो there is a heightened risk with seniority in the corporate sector. And thereafter, of course, there are issues of gender. Are we clear on this? Yes. So we have to be very, very careful in the way things are to be implemented. Are we okay? Yes. Good examples you can give Infosys, bad example. I know Infosys is not today a good example to give for work culture reasons, but compliance wise, Infosys is a solid company. But so Infosys, Tata Group, Unilever, these are very, very good run companies, right? Worst cases would be, I've given you the examples, Satyam, the Enron case. Of course, of course, of course. And then what do you effectively do to make it better? You strengthen board independence, there's better accountability, you're able to give better protection to whistleblowers. As we discussed back in the day, also, whistleblowing is not just a, it's not just a government entity concept. You want to whistleblow with respect to wrongdoings in the private sector also. क्या ये बात समझ में आई? Are we clear on this? Yes or no? ठीक है. Good. So CSR is generally done through non-state actors. CSR and non-state actors will pick up in a single lecture. And then we have three more lectures for social justice. IR is ready on the back end. Will be delivered to you before the week. Corporate law is services okay. So the function is effectively what the registrar of companies is supposed to do. But they haven't really, it's a very new service, they haven't really charted out their work, honestly. Their job is to basically enforce the Companies Act. This is their job. They are corporate governance professionals, but they've not been given the power and the scope and the mandate for all of this, unfortunately. Yeah. हाँ हाँ हाँ, सारे टेलीग्राम पे. ठीक है. डन. हाँ, आप बिल्कुल. हाँ दीदी, आपका कल मैसेज भी आया था. हाँ, कल कर ले. अभी करते, 1 घंटे में करते. ठीक है. थैंक यू.